Hello, good afternoon or morning, depending on where you are tuning in. Today we're going to talk. This is the fifth fifth of the 10 part Pillar 2 web series we've been running, and today we're going to talk about Article Three's GloBE adjustments. Before we get started here, I'd like to introduce myself. My name is Justin Metcalf. I'm a director with the Charlotte, North Carolina office of Forvis Mazars. And with me today is Ashton Castagna. She's a director with the Atlanta Forvis Mazars office. And we also have Deborah Knoll, who sits with the Forvis Mazars Netherlands office, and she is an international tax advisor. We are pleased to chat today. And, before we go into a couple of into the minutia of Article 3 of the GloBE rules, I do want to start this off with a recap of what has been discussed today and what will be discussed going forward. So, up till now, right, we've discussed how to characterize an M&E group, how, what the calculation steps are to figuring out your top-up tax for a purpose. What are the calculation steps from a forest view level for figuring out what your top-up tax is. Today we are going to go peel a layer of the onion and go a little more in depth into what these Article 3 adjustments require. And for those tuning in that are new to this, Pillar 2 is very much a new set of tax rules, right? Most of us in the U.S. and some in other jurisdictions will think about their own local country, book the tax rules, but Pillar 2 has its own kind of, uniform approach, and that's what we're going to unpack today. So for those that have been tuning in, right, in the first few sessions, we talked about how do you characterize an M&E group, and that was our step one. Today we are getting to step two in the calculation steps, and today we will determine, right, what is your FANL, your financial accounting net income or loss. We'll determine what are those, adjustments that get you from FANL to the GloBE base that's been contemplated by the OECD in over 140 countries back in October of 2021. And we will also talk a little bit about, PE and flow through adjustments where needed. So, before we go into that, right, let's do a quick recap. So in a previous session, right, we talked about what this jurisdictional top-up tax liability is. Today, that's, your jurisdictional top-up tax liability for a particular fiscal year for Pillar 2 is limited to three components: your top-up tax liability, any additional current top-up tax that you have to recognize for a jurisdiction, less any QDMTTs. Let's hone in on this left side here, the top-up tax liability. To figure out your top-up tax liability, there's this elaborate mechanical computation laid out in Article 5 of the model rules. It basically says you have to take your excess profits and compare that to the product of which is the top-up tax percentage. GloBE income is where we are centering in today in this chart, right? And as you can see, net GloBE income is what factors in on both sides of the equation. Article 3, in a nutshell, and there's a lot more components to this, sets out what GloBE income is, and basically, in so many words, says you start with your financial accounting net income or loss in the particular jurisdiction. You layer in any necessary book to GloBE adjustments, and what that means is those are certain components that figure up your base for Pillar 2, right? And you back out any international shipping income, which we'll discuss at the very tail end of this of today's session. So financial accounting net income, for the most part, is really starting with your books that have been adjusted for the UPE or the particular constituent entities, FANL for the respective jurisdiction, and it's usually relatively straightforward. But the one thing we're going to focus in is this middle component, the GloBE adjustment. So what are they? We've taken the time to kind of elaborate what these are and kind of called them listed versus other, right? And, the listed ones, as you see here on the left, right, and we're going to go through each and every one of these today. But the listed ones are the ones that have been enumerated in Article 3, right? And specifically listed with some commentary. We'll talk about these, and we'll also talk a little bit about the other ones that, in, for example, debt releases, right? That was the one that was introduced in the February 2023 administrative guidance last year. But it was contemplated in the original GloBE rules, but the OECD administrative guidance in February of 23 shed light on what that debt release adjustment is. So that's just an example of one. Another one we'll talk about is qualified refundable tax credit adjustments, and if you have an MTTC, which was also talked about in the February guidance and a little bit discussed in the July guidance. So we'll what you're seeing in front of here is really a list of all the GloBE adjustments you could be thinking about to conform your base for GloBE income. So without further ado, let's kick off our first polling question. Has your company quantified all GloBE adjustments in any of your jurisdictions that fail the transitional CBCR safe harbor test? We'll give you all a minute here. So, as you all, for those that have tuned in, if you fail the transitional CBCR safe harbor test, there's the once out, always out rule that forces you to have to go into the full scope GloBE calculation. Today's session really presumes you're going to have to really, you do fail the transitional safe harbor test for a particular jurisdiction, and what we're going to really go into is what are those adjustments. Now, there's a comment here. They're not sure the difference between listed and other. Listed is really we've coined them as the ones that have been listed, and then there's other, which is, so listed has really actually been spelled out in the Article 3 guidance, and then other is really it's in the administrative guidance, but it's not specifically enumerated in Article 3 as a list, like how you'd see these listed ones. So if you look at at Article 3, you'll see that. So we're going to shed light on all that today. So so it looks like it's a fairly rough split here. So good to know. So let's start with the listed GloBE adjustments under Article 3.2.1. And what we mean by that is these are the ones that are actually spelled out in the Article 3 rules. So, the very first one, is net tax expense. So, Article 3 requires that you add back any of the net tax expense to a constituent entity's FANL, right? So when you have a FANL, there's a deduction for taxes. There's a requirement that there's an add back. It could be a negative adjustment, right? Specifically in instances where there's a constituent entity that incurred a net loss through the creation of a deferred tax asset. Net tax expense is defined to include the net amount of your covered taxes, your current and deferred income taxes, DTAs attributable to a fiscal year loss, QDMTTs, and IIR UTPR taxes. Now, keep in mind, we'll talk about Article 4 in a couple of weeks from now. But QDMTT and IIR and UTPR taxes are not covered taxes, right? But you would have this adjustment with respect to non-covered taxes as well. So that's something to keep in mind. And then disqualified refundable imputation taxes on there, which are basically refundable taxes to the beneficial owner of a dividend. So without further ado, let me kick this over to Deborah to take us through some of the more elaborate listed expenses here.
Thank you, Justin. Yeah, let's move on to the next adjustment, which are the excluded dividends. Go back one. Yeah, the excluded dividends. This provision adjusts the constituent entity's FANL by reducing the income or increasing the loss by the amount of any excluded dividends received during a year. In general, excluded dividends are dividend paid on shares or equity interest, where the M&A groups hold 10% or more of the interest, of the ownership interest, or the constituent entity has held full economic ownership of the interest for a period of 12 months or more. There are some exceptions to this. First up are the dividends received from short-term portfolio shareholdings. Those are included in the GloBE income or loss of the constituent entities. These are dividends from shareholdings where the M&A holds less than 10% of the interest and has owned it for a short time, which is less than 1 year. In certain cases, dividends from short-term portfolio shareholdings may be exempt under local tax law. And this deviation may lead to potential decrease of the effective tax rate, the ETR, as the dividend is included as income for Pillar 2 purposes, but there's no corresponding tax as there is an exemption based on local law. And the second exception is related to dividends received from an investment entity that is subject to an election under the taxable distribution method in Chapter 7. And for today's session, we will not further discuss this specific method in detail. Then the following adjustments concerns the equity gains and losses. There are 3 types of gains and losses. The first one is changes in fair value. The second one, the equity method accounting, and the third one are the dispositions. Now, starting with the first one, the fair value method, it revalues the ownership interest, and changes in value are reported as a gain or loss in the P&L or in the OCI. And gains and losses on ownership interest, other than portfolio shareholdings, are excluded from the GloBE income and loss computation. Therefore, there's only an adjustment if the movement is included in the P&L. Then the second one is the income or loss arising from an ownership interest, accounted for using the equity method. You see that financial accounting standards typically require equity method accounting when the M&A groups holds a significant but non-controlling interest in an entity, which is between 20 and 50%. And the adjustment may be a positive or a negative. If there's an equity method net income, then there's a negative adjustment to the VANL, and an equity method loss is a positive adjustment to the VANL. And the last type is the excluded equity gains or losses, which includes the results of a disposition of ownership. This is specifically for the disposition of interest where the groups holds 10% or more of the ownership interest at the time of transfer. And this includes the sale of a constituent entity, joint ventures, and other non-portfolio shareholdings. And we just heard the term portfolio shareholdings when we discussed the excluded dividends. However, unlike the excluded dividends, the time period for holding the ownership interest is not relevant for the equity gains and losses. So merely the interest percentage is relevant. And in many jurisdictions, gains arising from a disposition of interest are wholly or partially exempt from tax or subject to taxation at a reduced rate. And if the difference is not adjusted for in the GloBE income or loss computation, that will have an impact on the ETR. So therefore, an adjustment should be made. Now let's proceed to the next slide concerning the included revaluation method gains and losses. Under some financial accounting standards, an entity can elect either the cost model or the revaluation model as its accounting policy for the property, plant, and equipment. And under the revaluation model, an asset is carried at a revalued amount, and revaluation increases are generally recognized in the OCI rather than the profit or loss. And without a corrective measure, the revaluation model affects the GloBE income calculation because the revaluation gains are typically excluded from the VANL, while the depreciation is based on the revalued amount. And therefore, an adjustment should be made to include this method's results. This election allows constituent entities to defer gains and losses in OCI from inclusion if the GloBE income or loss until the asset is disposed of. So any covered taxes associated with these gains or losses must be deferred until the asset's disposition. And the covered taxes will be discussed in our next session in more detail. Yeah, moving ahead, let's discuss the adjustments required for gains and losses from a disposition of assets and liabilities. This is also included in Article 6.3, the GloBE reorganization provisions. Results from asset sales are generally included in the GloBE income computation, even when the buyer is a group entity. However, for financial accounting rules, these adjust for intergroup transactions to ensure that these sales do not affect the group consolidated income. And the GloBE reorganization provisions generally requires that gains and losses from an asset transfer should be included in the GloBE income or loss. And to adjust for these exclusions, we need to make a negative adjustment for an excluded gain and a positive adjustment for an excluded loss. Yeah, the next adjustment is concerning the asymmetric FXGL, the foreign currency gains and losses. These occur when there is a difference between the accounting and tax functional currency of a constituent entity. So, for example, the financial statements are prepared in US dollars and the tax returns are in euros. And that being said, that also means that no adjustment is required if the accounting and tax currencies are the same. But when the currencies differ, there are 4 scenarios. The first one is that FX gains and losses reflected in the taxable profit of a constituent entity should be adjusted. These are FX results related to the fluctuations in exchange rates between the accounting and tax currencies. And the reverse situation is also possible. This is the case if an FX result is reflected when determining the profit and loss in the financial statements. And those results are related to fluctuations between the rates between tax and accounting currencies. And on the next slide, we have included some special scenarios, as in some cases, there's a third foreign currency next to the accounting and tax currencies. And the third situation is FX gains and losses, which arise due to different accounting and a third foreign currency. And the last scenario is that that will include FX gains and losses from third foreign currency transactions affecting the tax functional currency. And it could be the case that those results are not actually included in the taxable income, but regardless of that, you should make the adjustment. Now let's move to the adjustment regarding the policy disallowed expenses. These expenses include fines, penalties, and illegal payments such as bribes. And in principle, such expenses are disallowed, but there is a so-called minimus rule. And in that case, no adjustment is required for disallowed expenses if the total amount is less than 50,000 euros per year. And a side note is that interest charges for late tax payments are not considered fines, and no adjustment is needed for that. Now that we have covered the policy disallowed expenses, I would like to pass over to Ashton, who will guide us through the remaining listed adjustments and the upcoming polling question.
All right, thank you. So next we will continue on with another one of the listed adjustments within Article 3. So prior period errors and changes in accounting principle are provided for in 3.2.1H. So an adjustment's made to the extent there are any changes needed to a constituent entity's opening equity due to either a prior period error or a change in accounting principle. So errors are defined in Article 10 of the rules. Generally, this is a correction of a prior period error that impacted your GloBE income or loss in a prior year to the extent GloBE was applicable within that year. So really, you're just trying to make the adjustment in the current period. However, if the correcting error would require a corresponding decrease to your covered taxes, in a prior fiscal year of 1 million euros or more, then no adjustment would be needed in the current year, because you would be expected to go back and reflect that change in the period in which it occurred, just due to the magnitude.
And Ashton, just to add something here, one thing that I think is a very important point to consider when you're thinking about your book to GloBE adjustments, that there's a constant theme here, right? That what you do to your book, to your FANL, to go from book to GloBE has to have a corresponding adjustment, so you're comparing apples to apples on the covered taxes side. A very important theme between Article 3 and 4 is that what happens to one something must happen to the other, or else you have a distortion that the OECD and the countries that have enacted OECD's guidance as law are primarily concerned with. So you're going to see this throughout you're going to see this from here on, from Article 3 to Article 4 next session, that there is a pecking order where you have to think about what happens on one hand must happen to the other. So just wanted to interject and throw that out there.
Yeah, thank you. That's a really good point. So we would also adjust to the extent there was a change in accounting principle or a policy that would impact your income or expense that was included in your GloBE computation. And again, this would only apply if the equity adjustment is attributable to items of income or expense that should have been in your GloBE calculation. Next, we have another polling question. Which of the listed adjustments is most impactful to your company's GloBE calculation? Excluded dividend adjustment, excluded equity gain loss adjustment, asymmetric FX adjustment, or other?
There's while we're answering this question, there's an interesting question that popped up just now. Are changes due to the tax field audit and carried out included in the adjustments to the GloBE income? To answer this, this question here, I would say, if there is an adjustment to your GloBE, if from going from book to GloBE, and you find out that, hey, there is a missing, Article 3 adjustment in there, I think that would, your auditors, I guess, could find, if you're a company and you're subject to a public company provision or a private provision, right? And there are adjustments similar to how you think about, U.S. book to tax, right? If there's in the GILTI context, a tested income adjustment, it does factor into the overall top-up tax math. So you could, you could have changes that, you could put in an amount that you think is GloBE income, and if you're not thinking about other adjustments in there, it would hypothetically change your GloBE income. So this is why the focus on understanding the distinction between book to GloBE versus your other book to tax rules that that most companies are situated in becomes imperative. I hope that answers the question there.
Thanks, Justin. So it looks like there's a pretty decent split, with other being the most impactful between the ones that are listed. The excluded dividend adjustment seems to be most impactful. All right, and with that, we will go to our final of the listed adjustments that was included within Article 3.2. So accrued pension expense is covered in item I, and this is also defined in Article 10, and it's really the difference between the amount of pension contributions made for the year and the amount accrued as an expense within your financial accounting net income or loss. The administrative guidance released in February 2023 gave us a bit more color around this adjustment. So first, it is dependent on whether a constituent entity's financial accounting net income or loss includes an accrued pension expense or income with respect to a pension fund. So in the case of a pension expense, if the accrual within the financial accounting net income or loss is more than the annual contributions, you would have an add back. If the contributions exceed that accrued interest expense in your FANL, you would have a negative adjustment. Now, when it comes to accrued pension income, you would make a negative adjustment for the sum of the pension income plus the contributions for the year. So that's always going to be a negative adjustment when it comes to your pension income. We have a graphic on the next slide that I think kind of helps visualize this adjustment as well. So here you can see that your adjustment is really going to be your pension contributions for the year, and then you're going to add either income or subtract expense, and that amount calculated would then be multiplied by the inverse, and that would be your accrued pension adjustment. So next we have the other GloBE adjustments that we'll talk through. So first, the debt release exclusion election was first introduced in the February 2023 administrative guidance under section 2.4. This, I think, goes hand in hand with what Justin was pointing out earlier, with the need to kind of match up your taxes with the income. And that's what I think this provision was really getting at. So the term debt release refers to amounts included in income of a debtor following a situation in which the amount owed is waived or forgiven without being repaid in full. And so often jurisdictions don't tax that amount. So in this case, if the amount was included in your FANL with no corresponding increase in adjusted covered taxes, the constituent entity could end up in a substantial top-up tax position, which the guidance, points out would kind of go against the policy objective of using the tax system to assist financially distressed entities. So with that in mind, they provided this election to exclude such income from GloBE as well. There are specific situations in which this is a possible election to make. So with that, you either have to have bankruptcy proceedings. So under a statutorily provided insolvency or bankruptcy proceeding, or it must arise as a result of a third-party debt, and the debtor would have been insolvent within 12 months if not for that debt release. Or lastly, it must arise when the debtor's liabilities exceeded fair market value of its assets immediately before the debt release. And for you to be eligible under the third situation, it has to be a third-party debt. All right, next, Article 3.2.2 provides for an election for the constituent entity in which they may substitute the amount of stock-based compensation allowed as a deduction to the constituent entity's taxable income in place of the amount that's expensed within their financial accounts. And some of the reasoning would be for tax, the value of the compensation is based on the fair market value of the stock when the option's exercised. But for financial accounting, the value of the stock, the value of the compensation rather, is based on the present value of the stock at the time of issuance, amortized over the exercise period. This election is binding for 5 years once it's made. And there are certain provisions in which claiming a deduction for options that will never be exercised is not permitted. All right. Next, we have an adjustment that's provided under Article 3.2.3 for arm's length adjustments, which may be necessary. So transactions between group entities should be placed or priced in accordance with the arm's length principle, meaning the pricing should be consistent with what would be charged in a third party situation. So if there's a transaction between constituent entities located in different jurisdictions that's not recorded at the same price on both constituent entities' financials, or it's not consistent with the arm's length principle, then it must be adjusted for in your GloBE calculation. This doesn't apply to constituent entities to the extent they're located in the same jurisdiction. So you wouldn't have to make an adjustment in that case. And it also doesn't apply to losses if they're not included in the computation of GloBE income or loss.
You know, Ashton, just to add on, or sorry, real quick.
No, that's okay.
Just to add, yeah, just to add on the arm's length adjustment, right? Article 3 is really getting at kind of equaling the playing field for different jurisdictions. So this arm's length adjustment comes key. Now there are instances in the GloBE rules where, you may have, like this piece for arm's length is really getting to some of these countries like LATAM, right? In the LATAM area where, transfer pricing may not be required. So, if you have LATAM operations, this is something that we've seen, in practice pop up, and there's some mechanics to go through and think through. But I did want to note that this really seems to be geared toward some of these LATAM countries that don't really implement transfer pricing policies. Sorry, Ashton, keep going. Sorry, I apologize for that.
Absolutely, thank you. Yeah. And then I think the last bullet point is really just addressing if the 5-year consolidated accounting election is in place, then no adjustments necessary in that situation as well. So with that, I will hand it back to you, Justin, to discuss Article 3.2.4.
Okay. So, we're going to talk now Article 3.2.4, which talks about the qualified refundable tax credit adjustments, otherwise known as QRTC. So, what is a QRTC, right? Before I explain, the significance, right? A QRTC is really, it's a tax credit that's, designed to be, paid in cash, right? Or cash equivalents. And it will be paid within a 4 fiscal year period, assuming all events of that necessary for establishing that credit have been paid. Very similar to the all events test if you're a U.S. tax professional that needs to be thought about when you're recognizing income. A non QRTC is basically not a QRTC and could be something that's refundable or in whole or in part. So there's a spectrum before we go into the minutia of Article 3.2.4 that thinks about, there's QRTCs are really seen as a spectrum between, are you a QRTC and a non-QRTC, because that's how the Pillar 2 rules look at credits, right? And now there's this gray area, which we'll talk about here in a second, that was talked about in the February guidance, called MTTCs, marketable transferable tax credits. We'll allude to that here, but basically the general rule is if you have a QRTC, it's intended that the amount the amount is if you have a QRTC, the full amount of that QRTC is deemed to be GloBE income in the year of its accrual. Now it's a spectrum, right? I mentioned earlier that you look at this in a spectrum, and it very much is that way, because you could have a portion of a credit that is a QRTC and a portion that is not a QRTC, right? So if it's a QRTC, it's income, it's not a reduction. If there's a portion that's kind of disqualified or non-QRTC disqualified, it's seen as a deduction from GloBE income and loss. Now, this seems kind of like, okay, why would it qualify? There's a good connotation to QRTCs, right? So why this seems to be kind of punitive, but you have to think about the notion that, what we do on one hand, we must do to the other. So there are taxes there's tax adjustments that are favorable associated with this QRTC adjustment that need to be thought about. And we'll discuss that when we discuss Article 4 in next session. but keep in mind that this dichotomy between Article 4 and Article 3 must have parity, or else there is, you know, a serious foundational issue with respect to the base of which your Pillar 2 taxes are calculated. So, you know, that said, right, let's talk, you know, we established what I think QRTCs are here. So, you know, you're looking at something that meets within a four fiscal year period to be a QRTC to get that treatment. You know, let's talk about this MTTC adjustment, right? So the MTTCs, you know, for the most part, are treated as QRTCs. And what does that mean? As we established, if you have an MTTC, right, you have an adjustment to your income, and there's a corresponding Article 4 tax adjustment, right? This was actually established in the 2023 July administrative guidance. This was the second set of guidance that I guess was deemed to be administrative, you know, that came last year, right? That and you know, what is an MTTC? There's a spectrum here that we're going to talk about. So, you know, MTTC, right? It's any tax credit which meets all three of these requirements. One, it can be used by the holder of the credit to reduce its liability for a covered tax in an issuing jurisdiction. Basically, it's a true tax credit, and it meets a certain legal transferability standard in the hands of the holder, and meets a marketability standard in the hands of the holder. Understanding who the originator of a credit and who is the purchaser of a credit is key here, and that's what this July guidance talks about for establishing these. But before we do that, let's get to a polling question here. So let's you know, while you all answer that, you know, understanding, you know, so there's a question here about QRTC, when it's included as income, when it's accrued. The answer to this, you know, it varies a little bit, but you know, the question here is, you know, is it included when it's accrued? You know, the answer to that is generally, you know, when it's recorded in your FANL, right, you would include it, but you have to also consider, right, you know, the 4-year testing threshold of, you know, will you actually recognize it? Will all events be tested within the 4-year period to make it a QRTC, right? If you do, right, if it falls within the 4-year period, it stays on there. But I guess what the gist is, people need to be thinking about is, if we get to a period where it suddenly it's been accrued, it's been recognized, and we get past the 4-year period, then what ends up happening is you may have to think about post-filing adjustments, right? And that could kind of complicate it. So, you know, one key item here is thinking about the actual adjustment, right? You know, and when all events will be satisfied within the 4-year period, and then after that, you know, and monitoring that, because if it does change, you could have a correction to your GloBE income, and then that queries whether you need to, you know, pick up an additional top-up tax liability in the current year from recalculating from a prior period, or whether it meets a de minimis threshold somewhere in the GloBE rules. So very good question. So there is a tracking mechanism that needs to be thought about. But so in the interest of time, since I know we don't have a whole lot and we have a little bit left here, the legal transferability standard I mentioned earlier, you have to think about who's the originator of a tax credit and the purchaser, right? The origination. So if the tax credit regime is designed where the originator can transfer the credit to an unrelated party in the origination year or within 15 months of the end of the origination year, you meet the legal transferable standard. That's if you have a purchaser, you know, it's really when you transfer, right, to the unrelated party. In the interest of time, we'll get past here. There's a marketability test as well, right, that looks to a marketable price floor, right, evaluates the net present value of the tax credit to 80%. And again, you look to the originator, right, and if you can, if it can be transferred to an unrelated party within a 15-month period at a price that equals or exceeds the marketable price floor, you meet the marketability test. If it's a purchaser, right, it needs the price must equal or exceed that marketable price floor, which we established is 80% of the net present value of the tax credit. You see a lot of this in these EU in these EU credits that are being established now, and some actually in Australia from others that I've discussed. The U.S. there's a question about where some of the Inflation Reduction Act credits fall in, and that's probably a grayer question to a grayer answer to that, where a lot of companies are evaluating how some of these Inflation Reduction Act credits fall into the spectrum. So if you have questions on that, we're happy to address them and discuss them with you over a consult. So in the interest of time, what you want to do, right, what these three standards are really looking at is refundability and transferability. If it could be transferred, you want to fall into this QRTC threshold. So if it's paid within 4 years, if you could get the full refundability within 4 years, you are generally going to fall in the QRTC spectrum. But you also have to measure it with the transferability. If it's a true market, if it could truly be sold and marketable to others, right, that will also. So the secret sauce to the QRTC question, does an MTTC become a QRTC, is it needs to be pretty transferable, right? And it must be recognized within the 4-year period. All events that establish a credit must be recognized within the 4-year period. Otherwise, you get non-QRTC treatment, and what ends up happening is you get the deduction treatment for Article 3 and the corresponding adjustment for Article 4. So without further ado, right, I will kick this back to Deborah here to talk through the fair value gain loss adjustment.
Okay, thank you, Justin. The next election introduces an option for handling the recognition of gains and losses from fair value or impairment accounting under the GloBE rules. This election is designed to align the timing of income recognition with the actual economic events. And once the election is made, it cannot be revoked for a 5-year period. And once the election is made, it cannot be, if it has been decided that you do not elect for the adjustment, you have to wait 5 years before you can make another election. And if revoked, an adjustment must be made to account for the net fair value gains or losses during the election period. And the effect of the election is that gains or losses from fair value or impairment accounting are excluded from the GloBE income. And instead, gains and losses are calculated based on the realization method, using the carrying value at acquisition or when the liability occurred, or the year that the election begins. Next up are the asset gains election. This election allows M&A groups to spread capital gains or losses from selling local tangible assets over up to 5 years. And this mechanism mitigates the impact of a large one-time gain on the jurisdictional ETR. And the election applies to local tangible assets, which are specifically immovable properties located in the same jurisdiction as the constituent entity. And the gains and losses are matched against prior losses from similar assets during the look-back period. And the look-back period is the current year and the past 4 years. And if the gains exceed the prior losses, the remaining amount is spread evenly across the look-back period. And this election is made on an annual and jurisdictional basis. So you can choose this when it's beneficial for you.
Just to add to this here, some color to this here too, in practice, we've experimented with this election here, and I would query this to anybody that's thinking about, where you've had a disposition of local tangible property for local purposes. One of the key considerations to think about for this specific election is you want, like, especially when you have like NOLs in a jurisdiction, you want to balance, spreading this gain from a local perspective too, because we've seen some relatively interesting ripple effects that could happen. It could help you from a Pillar 2 standpoint, but having that, there could be a corresponding effect from a local standpoint that affects your attributes when you think about this from a go forward basis for Pillar 2 purposes. So understanding, when you're modeling this out, you want to think about your local, what it does local on both sides, actual local law and from a Pillar 2 standpoint. And we'll learn, in the next session when we talk about like the blended CFC allocation regimes, you're seeing similar things that local elections could affect, the GloBE piece. So the key takeaway here is modeling. So sorry about that.
No, thank you for adding. That's a good point. Yeah, then let's move ahead with the next adjustment, which is the intergroup financing arrangement expense. And this adjustment aims to prevent tax manipulation through intergroup financing arrangements. And these arrangements are where low tax entities reduce its GloBE income without increasing the taxable income of a high tax entity. And an entity is basically considered a low tax entity when it is located in a jurisdiction with a GloBE ETR of below the minimum rate of 15%. And an intergroup financing arrangement is an arrangement between two or more members of an M&A group, whereby the high tax entity directly or indirectly provides a credit or otherwise makes an investment in a low tax entity. And there is an intermediary exception for constituent entities that fulfill a treasury or a financing center function within their group. And the adjustment is basically that payments to high tax entities that are offset by tax benefits are not considered to increase the taxable income of the low tax entity. So an adjustment will be needed in those cases. And then moving to the next slide, that's for the intergroup transaction. I see that the title is the same, but this for the intergroup transactions. I think, Justin, you wanted to say something?
Yeah, so one thing to think about in these intergroup financing arrangements where you have expense being eroding away from a low tax jurisdiction into a high tax jurisdiction, intergroup financing arrangement, for those that are modeling the transitional CBCR safe harbor today and are thinking about hybrid arbitrage arrangements, it's really one of the an intergroup financing arrangement could fit within one of those molds of a deduction non-inclusion regime. I would argue that the hybrid arbitrage arrangements that are being applied for transitional CBCR safe harbor testing is a relatively more broad encompassing, right? So if you have this kind of arrangement, you may want to also think about what this does from a hybrid arbitrage arrangement when you're modeling for the transitional CBCR. Because that is a little more of an all-encompassing adjustment. And in the most recent, the December 2023 administrative guidance, there is commentary in the OECD rules that talk about that the OECD is exploring whether a broader kind of hybrid arbitrage rule that's applicable to the transitional safe harbor should apply to the full scope calculation. So just wanted to add that commentary in there as well.
Great, thank you for adding. Yeah, then the next slide for the intergroup transaction. This is an election which allows M&A groups to apply consolidated accounting to transaction between constituent entities located in the same jurisdiction. This eliminates intergroup income, expenses, gains, losses from the computation of the GloBE income or loss. it requires tracking of jurisdiction-specific transactions. And if the election is revoked after a certain period, then adjustments are required to ensure that there's no duplication or omission of GloBE income or loss.
Just to add on to this too, Deborah, for this Article 3.2.8 from a U.S. standpoint, right? For those that are privy to U.S. federal income tax principles, specifically with CFCs, this article, this consolidated election, right, is very similar to how we think of for those that do GILTI in the 163J grouping election. You start to see some strong similarities between Article 3.2.8 and the CFC grouping election under 1.163J-7 of the U.S. Treasury regulations. So think about it in that context, just for those that are in the U.S. standpoint.
Great. Thank you, Justin. Then the following adjustments are specifically for the insurance and banking sectors. Based on the provision 3.2.9, certain income from an insurance company is excluded for the GloBE computation of the GloBE income. Insurance companies often pay tax on returns owed to policyholders, but they pass this tax along to policyholders by reducing their liabilities. And based on the accounting standards, the tax may be recorded as an expense within the profit or loss before tax in the financial statements. And this election only applies if the tax is not treated as an above-the-line expense in the financial statements. So then an adjustment can be made. And then the next article is 3.2.10, which is for the additional Tier 1 capital. This is an instrument issued by a constituent entity, which is a convertible instrument which can be converted to equity or may be written down in very specific events, for example, a financial crisis. And distributions linked to this additional Tier 1 capital are treated as an income or expense in the computation of the GloBE income or loss. But any adjustments for issuance or redemption of the additional Tier 1 capital are excluded from the GloBE income or loss. And then next up is the GloBE M&A adjustments. There are certain adjustments that should be made to a constituent entity's venal to align with the rules in Chapter 6 and 7. There are special elections, which could include that specific dividend income is included in the income or loss and the adjusted covered taxes. There are quite some adjustments, so I don't think that we will discuss these adjustments in further detail today. But maybe Justin or Ashton, you have something to add to this?
Yeah. So there is going to be in our 10-part mini-series, we will dive in a little deeper into, Article 6 and Article 7 and the GloBE reorg rules in a later date. But this is really just a placeholder to think about the adjustments to income that you need to think about when applying the full scope calculation. So this is very much a to be continued that we will discuss at a later date.
And next up is the final polling question for today. And the question is, has your company considered any M&A activity in response to the implementation of the GloBE rules? So let's take a moment to respond to this question.
And, while we're taking the time to answer this last polling question here, today was very much intended to be, kind of a perusing of the Article 3 GloBE adjustments. We could be here for hours talking about, the complexities with respect to each one of these adjustments. And it's also important to acknowledge that, I mentioned earlier that, when we were discussing intragroup financing arrangements, right? When Deborah was talking through that about the intragroup financing arrangements, that these rules are evolving. The OECD, could release new guidance about different adjustments that get us to that common unified approach that was discussed when the December guidance was released. And as these rules evolve, some of these adjustments, we may have more, we may have some dialed back, and it's important to monitor, how these adjustments evolve and where we are today, versus where we were yesterday, because nothing is truly set in stone until the OECD releases on it, and more importantly, right, the OECD is not law. Countries actually adopt these into their local jurisdictional laws. We had the benefit of knowing that the EU has adopted a lot of these adjustments in there. I think almost all of them, but don't quote me on that. But it's important to understand that the evolving nature of these adjustments, and this is where we are today. It certainly may not be where we are tomorrow. So please keep that in mind when you're thinking through these adjustments at that level. So looks like a whole lot have not considered M&A activity, and I think that jives with what we've been seeing there. There are other kinds of elections that we'll talk about when we in the later session that companies are considering making with respect to turning on IIRs, UTPRs, and QDMTTs. So for those that are interested in that segment, please stay tuned. I think we talk about that in the later sessions after we talk through Article 4 at some point. So without further ado, let's get to the last piece here. We discussed the article, how you get GloBE income. You start with your panel, you start with your GloBE adjustments, which we've bifurcated for ease of review between the 3.2.1 listed ones and then everything else that's been enumerated in Article 3, which we call other, and added on through the administrative guidance. So there is an exclusion available to GloBE income for international shipping income, and basically, we don't to tidy this up in a minute. And let everyone go on their very way. You're basically looking for transportation, leasing activities of transportation or cargo vehicles, and or sales, right, with respect to international traffic ships, right? When you're thinking about this, you're thinking about it from a cross-border perspective. So I'm going to use Germany as an example, right? Cologne, right? If you have someone, moving cargo on the Rhine from Cologne to the Frankfurt area, right? That income itself does not qualify as international shipping income exclusion because it's intra jurisdiction. You're really looking at if it leaves, if the cargo leaves Germany to a different country through the same waterway. So inland waterways pose a problem with this, and I think the OECD got this rule right, because what you're really looking for is making sure you consider shipping income in the context of cross-border, because intra-border is often seen as a logistical movement, a logistical cost for the movement of cargo or inventory. So Article 3.3.3 really sheds light on that, and for those that are interested in a more detailed analysis on that, we are certainly here if you're in that industry and need a consult on that. So I think we're at the end of the hour here, so I just I know everyone's time here is precious, and it's a busy time of year, even if it is post 10/15 on the U.S. side. Year end is coming up, and this Pillar 2 is what we've seen in the market. As Pillar 2 is popping up for quite a bit of people and companies here, and so we do want to say thank you for your time today and for tuning in, and tuning in for those that are regulars on this. We do appreciate your time, and we look forward to giving you some guidance on Article 4 in the next session there. So please stay tuned. Thank you for your time.